Hello everyone, welcome back to my channel. So it's been a while since I've made one of these videos, and first of all I'd like to thank everyone who has contributing for the success of this channel. It's still a small channel, but still the fact that it has been getting some traction over the last couple of weeks. Yeah, it's been an absolute pleasure to provide this content to you, and so I want to appreciate all the views and all the feedback that I've been receiving recently. And this video is about an aspect that I did not convey properly over the course of the current challenging that I'm doing, the Road to 100K Realized Return Challenge. And as you notice, certainly if you follow those videos, I made some changes in the strategy that I use. As you recall, previously I focused mostly on ETFs that follow the main indexes on the US stock exchange, in particular the QQQs, which follow the NASDAQ 100, and also the IWM, which follows tracks the Russell 2000, the small cap index. But as you notice, over the past couple of weeks, I made a few significant changes. I'm tracking those ETFs, and so I decided to focus on metals, and especially in particular gold, silver, also copper, and I also try to focus, give some focus, because I don't want to be fully exposed to metals, but I also wanted to focus a little bit on particular sectors of the economy. And so that is why I am using, for the most part, also this consumer discretionary, consumer staples, some oil as well, some financials. And so this has a point, and there is an underlying reason for this. And so I want to say 5 reasons why I made this change in the allocation of our buying power week in and week out. And so the first one, and I think this is a very important one, is that currently, as you all know, equities are at all-time highs. The stock market has been pushing further and further up all over the past few weeks, and equities have been on an absolute rampage, and so they are very close at this moment to all-time highs. There was a little bit of a pullback last Friday, but still they are quite stretched, I would say. And so if you remember the struggles that I have been already facing with the Qs, so if the equities now are even at a higher level, all right, that means that for every put that you sell, you have to commit more money because you have to provide more collateral. And as the stocks and as the index go higher, the chances of a pullback increase, because that's normal, unless the market takes a breather. Of course, the stocks will continue to go up, but there is some sort of a breather. A market must take a breath at some point, and so I don't want to be caught at the all-time high. The puts are assigned to me. We are stuck at a very high cost basis, and then we are basically in survival mode, like it happened in the past one month ago or 2 months ago, when we were getting almost nothing out of the calls that we sold on the Qs. And so this is basically the reason why I decided to divert away, because it requires you much more money, the possibility of getting stuck again, like we have been already twice last year and this year already with the Qs, and we really don't want that to happen again, especially because the more expensive they are, the bigger share of your account size you have to allocate to those, and that means that you cannot diversify as much. And what that means also is that if you are caught up and you are forced to buy the Qs shares, for example, what happens is that the shares are so expensive that you cannot do anything to lower the cost basis, because your account size is for the most part already allocated to those shares, and so there is very little. You have no maneuver room to lower our cost basis so that it then becomes easier to get out of the trade. You basically have to wait until the market recovers completely from where it started to fall so that you can get out of the trade. And this is very, very suboptimal, and that's why I decided to divert away, at least for now, from those trades. Of course, if the market has a pullback again, I may consider it, but for the time being, I don't think it makes any sense at all. And for the second reason is that is not so much about the market itself, but about the companies themselves. And companies, if you follow the market and you have following the earnings releases that by now most of the companies have been reported for the first quarter, you have noticed that the headline, and this is where it comes all around the news, is that companies have been, for the most part, beating the earnings estimations by, or the earnings forecast by analysts, which on the surface is a good thing, all right? Because if you are beating estimates, that means that the companies are outperforming and they are providing more earnings, they are getting providing more value to the investors, and so they can distribute more money across to the investors, even in the form of dividends or stock buybacks, whatever it may be. But there is a very nuanced detail about this. If you look at the company, the 10 case, the financial reports, is that many companies are reporting these big earnings, but what comes out of it is that companies are very much focusing on reporting earnings on an adjusted basis. And what this means is that they have to report their earnings, all right, for the period, as is required by the generally accepted accounting practices, or the GAAP. But they also give a big focus on the adjusted earnings. And what this means is that they are basically saying that, all right, whatever one charges, whatever stock compensation, whatever, for example, amortization of intangibles are taking place, because these are mostly non-cash charges, we are reporting these as non-important or as detrimental for the earnings, but they are not really material, and so we are providing the earnings as must be reported by the GAAP, but we are focusing, all right, on an adjusted, from an adjusted perspective, these were the earnings that we had, with all of these these charges and these amortization of intangibles out of the way. Of course, the earnings come inflated, and they are giving so much focus in their text for these adjusted earnings that sometimes the layperson or the less attentive investor may disregard it. And I don't think this is correct, because in the end, whatever you have, one-time charges, or you have amortization of intangibles, if they are in there, they are there for a reason. For example, another thing that sometimes it gets taken out of the adjusted earnings is the stock compensation. If you are providing stock compensation for your employees and your board or your senior management, that is also a cost for the company. But because it's a non-cash, for the most part, they are taking it out of the earnings, and they are reporting this also as part of their adjusted earnings, and so this masks the reality a little bit, and I don't think this is much correct. Of course, I did not see all the reports that have been coming out. I can expect that the earnings coming down would be much closer to the earnings expectations. Maybe some companies would probably not beat the earnings expectations, And so this is a situation that has been happening, and they try to stretch the limits of what they can do with their accounting. This is borderline unethical, and so I think that the reality is not as rosy as they are trying to portray, and so I don't want to be too pessimistic about it, but this is for me is a red flag, and it takes me a bit away from being wanted to be exposed to this kind of to these companies basically. Now, another thing, and also regarding the companies, is the fact that, as you know, the subscription model has become pretty much ubiquitous among many companies in the US economy. The subscription as service, the whatever a service. And for me, I don't have anything against it, but the subscription model and the service, as a service model, as an issue, which is when you have to report the earnings and the cash flow on these services, what happens is that generally accepted accounting practices, or the GAAP, say that you have to report your revenue as it is earned. And so what happens is that when you have a customer that buys a service from you or a subscription from you, what's going to happen is that you can only report the revenue as on a month-by-month basis. If it is a monthly subscription, the revenue from that you have each and every month from the service, you have to report it on the revenue, on the top line of your income statement, every single month. All right, you report that the portion that is pertaining to that particular month, and of course then on the balance sheet you report a liability, which is a deferred revenue, which is basically all the revenue that the service is expected to provide only during throughout the duration of the contract. But and so what happens is that every single month you take a little bit out of the deferred revenue and you put a little bit on the income statement, so that the liabilities and the equity remains always unbalanced. You take a bit out of the deferred revenue and you put a little bit on the revenue in the income statement. But and this is for the most part correct and it's fair. Now the problem that I have is with the cash flow statement, because what happens is that if you buy a service in a subscription model, many services want you to provide the money up front. You have to pay for the whole year already. And because it's a cash flow statement, there is no accruals like it happens with a balance sheet. And so you have to report all the money that you received instantly, because you received all that money for the whole year. Even though the service will be provided over the course of the year, you already received the money, so you have to tell that, all right, I already received this much money for the whole year in this particular period. And so what happens is that the cash flow statement will become inflated, very much inflated relative to the earnings. And so this gives the impression that the company is generating a lot of money, much more money than their income statement would let you know that it's happening, just because of this. And so as a result, if this becomes widespread, the companies are reporting a lot of cash flow, all right? It becomes very inflated and gives the perception that the free cash flow generated by the company is awesome, is very good, even though it's a direct result of the type of service they are providing, of the type of sales that they do. And so this is also something that I've been noticing. Companies are inflating very much their cash flow from operations because it's an operating cash flow. Because it's part of the revenue, and so what happens is that people, I think people are getting a bit carried away with these estimations. My bad. What I mean is that companies are getting a little bit carried away with this, and that is also one of the reasons why their performance seems so much better than what they actually have in terms of their business performance. And they need to continue to, what this basically means is that they continue to bring more people in to their subscription services in order to keep this pattern of a very high level of cash flow ongoing, and keeping also the revenue increasing at a very sustained level as they take something out of as they take a portion out of the deferred revenue and put it in the income statement. That is why also the reason it happens already that with, for example, companies in the Max 7, that sometimes they beat company earnings, they beat the earnings estimations, they beat the revenue, but because they are not growing their customers base as quickly as possible, the stock, once the earnings and the guidance are reported, the stock comes down, because investors are starting to realize this model is very much dependent. In order for the financial statements to become good looking, they need to continue to keep the customer base growing at a certain rate. And given the fact that the valuations today are so stretched, this means that a little bit of a slump in that growth rate will bring the stocks down. And so we are getting a point in which every single shaking, as small as it can be, shaking of this foundations of this model occurs, the stock are bound to come down. And so this is something that I would rather avoid, especially because given the strategy that we are pursuing with this challenge, we want low volatility, you see, because that's where we get the premiums, and we get less premiums, but on the flip side, we remain very flexible, because the lower the volatility, the least likely our puts are assigned, and so this is basically what we want. And also because of this situation, another thing that also comes to my mind is that, and this is one of the reasons I prefer to stay away from equities at this point, or the main indexes for that matter, is the fact that at this very, very moment we are witnessing a growth rate of the US economy that, if you look a bit deeper into the components that are making this growth rate, the US economy growth rate happening, the drivers, you look that they are very much dependent on, I would say, three main components, which is healthcare, because healthcare is the only sector of the economy that has been producing jobs at a significant rate, at the rate that you would say, all right, if this happens to the rest of the economy is in very good shape. But this has not been the case. And the only real, or the only noticeable or relevant job growth that we have been witnessing in the US economy, I would say even the past year or 2 years, has been in the healthcare sector. And the healthcare sector is not particularly value adding. And so an economy is not supposed to grow and be prosperous on the basis of healthcare. There are other sectors which are more important for the good performance of an economy. Another component, as we all know, and this is something that concerns me a lot, is the fact that there has been a lot of investment in capex from tech companies in data center infrastructure buildup. Now, on the surface, this is a good thing because they are creating capital, all right? They are creating infrastructure to support their business. Of course, we all know what's going on with AI at the moment is expanding and is improving at a very much rampant rate. But as we all know, and this happens in every single time in history, there is a groundbreaking technology breakthrough. We all know that when these investments are made, all right, at the end of it, there is always some overcapacity. And so what's going to happen is that, this is my perspective, of course, this is my opinion. And so what I see happening is that some of this overcapacity will become obsolete very, very quickly. And why is that? Because at the rate that chips are being created, let's just say the lifespan or the useful life of a chip is becoming shorter and shorter. And so any overcapacity that occurs in this in this data center and infrastructure build-up, any overcapacity will become obsolete very, very quickly. And what's going to happen when some infrastructure or some physical capital becomes obsolete? It has to be written down. And companies, because they are obliged to do it, because of the accounting practices, what they have to do is that they have to write off much of the investment that they did. And as you know, if you know, of course, accounting, what's happening is that they invest in capex, they build physical capital, infrastructure. It goes on the long-term assets of your balance sheet. But then, as you write things off, how you write it off is that you reduce the value of these assets, and to keep the balance sheet balanced, you have to report it as a loss in your income statement. And when this happens, of course, investors will not be happy. And so this is something that I don't think it's going to happen today or even probably in the next year or two, but eventually this will happen. And so I expect that some companies will have losses because of this, and I would rather not be exposed to this kind of reality, because we don't know when this thing's going to happen. All right. Sometimes you see online that some projects for data center infrastructure are being cancelled, but yeah, this is something that may go wrong. And so I would much rather, if you are still positive about equities, I would much rather be invested or exposed to the companies that sell the chips, right? And we all know what those are. Instead of those who buy the chips to build the infrastructure of data centers. Again, this is also another reason. And if you look at these two components, so healthcare and the data center build up, these are the two of the reasons why, or two of the main drivers of the growth rate of the GDP of the US economy. But the third one, which leads me into the fifth factor while I'm avoiding this, is the government expenses. And the government expenses have been a ever increasing contributor for the US GDP growth rate. All right, this could be a good thing if the government would be also making capital investment, but it's not the case. The component of the government expenses that have been rising all the time is government expenses for current expenses, being social security and all those expenses that they are not providing. They will not provide a return in the future. They are expenses, and they are expenses that occur every single month. All right. And now, going to my fifth factor, or fifth reason, the reason why this keeps growing every year, the government expenses, is because the U.S. budget deficit has been always maintained at a very large rate, at a very large percentage. The U.S. budget deficit has been consistently 5-6% of GDP, and this is unsustainable. We all know what happened. I'm from Portugal. I saw firsthand what happened in Europe when countries have persistent budget deficits, and because they don't hold any sort of reserve currency like the US, investors got worried. They ditched our debt. Our yields skyrocketed. In the case of Portugal, they had to ask for a bailout, and this bailout, hit the economy really hard. And so, I'm not saying this is going to happen in the US. The US are in a completely different situation. They are already very indebted. The federal debt is already over 120% of GDP, and with these deficits, it's going on a completely unsustainable path. But they because they hold the reserve currency. We have been seeing that some central banks are already ditching some of their dollar reserves in favor of other things, such as gold, for example. Of course, because they are fearful that the dollar it will not stop being the world's reserve currency, but some value that the dollar currently has, which is, I think, at this moment 1.16. 1 euro, for example, is $1.16. Some of that value comes exclusively from the fact that it's the world's reserve currency. And if the US would not have the world's reserve currency, for sure the currency would not be as valuable as it is today. The yields, even though the yields are already very high, we see the 10-year US bond is already touching 5%, which is super high for a country with an economy of that size. It's ridiculously high, I think. And so this situation for me is very concerning because, as you know, and you see my videos of the challenge, I am very much exposed to the US dollar, and as we know as well, precious metals, gold, silver, in particular, act as an edge to this potential devaluation of the dollar. And so this is also a way to hedge our current exposure to the dollar, so that if the dollar happens to fall, we are somewhat protected. And you could see that in that particular sense, the market was not completely wrong this week, because as you saw on Friday, and I told this in my last video, metals completely came crashing down. In the case of silver, it came down more than 8%. I think it was 9%. I mentioned in the video. And why is that? Because even though yields got higher, and so this would be a catalyst to invest more in metals, for some of the money go to metals. But because the US dollar risen, because of the expectation of higher interest rates in the US, the metals came crashing down. And so you saw this situation happening. I don't think it makes much sense, the yields going higher and the dollar being lower. I don't think it makes much sense, but sometimes the market delivers us these nuanced situations. But I think this is something that should concern basically the people who are in a position of power in the United States, and especially, and this is something that is really bugging or yeah, strange and alarming is that since the Clinton administration, that's yeah, former President Bill Clinton, was the one that managed to balance the budget of the U.S. economy. It started in '98, and the budget surplus went up from 98 to 99, 99 to 2000, and then when the George Walker Bush administration came, even in 2001, the budget surplus was already smaller, but there was still a surplus. But from that point onwards, from 2001 onwards, after 2001 was still a surplus, but from 2002 onwards, there was always a budget deficit. And we went through a 2-year term for the Bush administration. We went through a 2-year, 2-term administration for the Obama administration. Went through 1 term, the first Trump administration. We went through a 1-term Biden administration. Now we are on the second Trump administration, and nobody is able to do anything about this. And if you follow the news, you probably saw that despite all of this, and despite the fact that now, for example, some of the government revenue that came from the tariffs that the current president decided to enforce, that money has to be returned now. But even despite that, the current president, Donald Trump, announced that he wants, let's see if he follows through, but he wants to expand the budget for the U.S. military by $500 billion. Now, where does this money come from? The U.S. is already running a budget of around 5%, 6% of the GDP, and so this will add at least probably another 0.5% to the federal budget deficit. And nobody sees nobody sees the train coming. And this is so strange, because they are bringing the U.S. government into the ground, financially speaking, and nobody is able to have a handle on this. And of course, something has to give. The can cannot be continue to be kicked down the road. And so that is why, for me, being in metals, being more exposed to metals, I think it acts a bit of a hedge, because I think it's pretty much certain, if something wrong in these aspects that I mentioned, if something wrong happens, people and investors will rush to metals. I'm probably way ahead of time, and in the market that doesn't really matter, but it's a way, given all of these factors, is a way to have some sort of protection. It's not ideal, because, as you know, metals are very volatile, and we want to be in a low volatility set of exposures because of our strategy. But that's also the reason why I prefer to use ETFs, and not even ETFs that are directly exposed to the metal, but ETFs that are exposed to the miners of those metals. And so, yeah, in a nutshell, these are my main concerns. And of course, now we are reaching the end of the end of the challenge. So this may be only a short-term concern for those who follow the challenge. But if you are investing, and if you are thinking that, all right, I want to do something similar to what I'm doing here in the challenge, even for your future, for your investments, I think everyone should pay very close attention to this. And because at the end of the day, if everything remains as they are at the moment, and things continue to run this course ad eternum, something has to give. And yeah, it's it's not going to be nice, because the U.S. federal debt cannot continue to run indefinitely. Budget deficits cannot continue forever to be 5 and 6% of GDP, and so, and the U.S. economy cannot continue just to grow on the basis of healthcare. We are witnessing 2.5% GDP growth with a budget deficit of 5-6%. So debt is growing much faster than the GDP, and if we use if the US decided, all right, from today onwards we are going to run a balanced budget, the economy would be a recession, because you would be taking 5-6% of the GDP out of the economy. If the economy is growing at 2.5%, that would mean that GDP would be lower. It would decrease. So yeah, you do the math. It makes absolutely no sense that the markets today are at all-time highs when you see this red light flashing in the horizon. But yeah, sometimes these things only come to light much later. But yeah, tell me what you think about this. Leave your comments in the comment section down below. I'm always available also on LinkedIn if you want to discuss this topic further and you want to exchange some opinion. And as always, feel free to like the video and subscribe to the channel. And yeah, we'll see you again in the next video.